Let's start with something that the markets seem to have shrugged off: the war in Iran. On February 28th, the United States and Israel attacked Iran and entered into an armed conflict. The Strait of Hormuz, the narrow waterway through which roughly 20% of the world's oil and a quarter of global liquefied natural gas passes, has been functionally closed since then. The IMF called this the biggest energy shock since 1973. Brent crude has pushed above $85 a barrel. Global inflation is running at 4.4%. And in the IMF's worst case scenario, if the strait stays closed, they put global growth close to recession and inflation potentially spiking to 6%. And yet, Wall Street is at a record highs. The market has essentially placed a bet. This conflict is temporary. Oil production in the US, Canada, and Brazil will fill the gap. That might be right, but it is a bet. And historically, markets that ignore geopolitical tail risks tend to get surprised by them. Here are the numbers that should make you uncomfortable. Let's talk valuations. The S&P 500 is currently trading at 32.4 times trailing earnings. The historical average since 1957, 19.7. That's a 64% premium over the long-term average. The NASDAQ 100 is at 35.5 times earnings, 45% above its historical median. But the most alarming figure is the CAPE ratio, the cyclically adjusted price to earnings ratio, developed by Nobel laureate Robert Shiller. It smooths out the boom and busts of earnings cycles using a 10-year average. As of May 2026, the CAPE stands at 42.3 times, compared to a long-term historical average of around 17. That's a 148% overvaluation. To put that in context, the only times the CAPE has been this high, prolonged periods of zero or negative returns followed, including 1929 and the dot-com crash of 1999. Then we have the question about the AI bubble. The engine of this bull market is artificial intelligence. And the story is compelling. NVIDIA, Meta, Alphabet, that's Google, Microsoft, these companies have driven extraordinary returns. The 10 largest companies in the S&P 500 now represent 41% of the index's total market cap and generated 53% of its total return in 2025, according to Goldman Sachs. On top of that, three of the world's most valuable private companies are expected to go public before the end of 2026. SpaceX at a projected valuation of $1.75 trillion, OpenAI at $852 billion, and Anthropic, the makers of Claude, at $900 billion. If all of these three companies list, the market would need to absorb an unprecedented volume of new shares in just a few months. But here's the problem. The returns on AI investments are not showing up yet. Goldman Sachs found that nearly $700 billion invested in AI infrastructure through 2025 had no measurable impact on US GDP growth, other than the construction itself. An MIT report found that 95% of organizations piloting generative AI saw zero return on investment. SpaceX implied price to sales ratio exceeds 80, and they currently have losses, not profits. OpenAI exceeds 58 times sales. Again, not talking about profits, but sales. Michael Burry, the investor who called the 2008 subprime collapse, has publicly compared the current moment to the final phase of the dot-com bubble in 1999. His firm has taken short positions on NVIDIA and Palantir, arguing that AI chip depreciation is being systematically understated, inflating reported earnings. AI infrastructure, wrote Burry, is catastrophically oversupplied. Then we have the silence of the CEOs. Financial journalist Andrew Ross Sorkin recently published a book about the 1929 crash. And when CBS's 60 Minutes asked him about today's market, he was blunt. There will be a crash, I can assure you of that. The question is when, and nobody can predict that. But what struck Sorkin most isn't the valuations, it's the silence. He observed that most major corporate CEOs are reluctant to speak openly about market risks. Some out of genuine uncertainty, others out of fear of antagonizing President Trump. He called it a culture of silence. And he said that paralysis, the unwillingness to name the risk out loud, is itself a warning sign. It happened in 1929 too. What this means for Latin America and Ecuador. For listeners in Latin America, here's why this isn't just a story about Wall Street. When the US market crashes, three things happen simultaneously in Latin America and in other developing regions. Capital flees to safety in dollars and US treasuries, widening sovereign spreads and raising borrowing costs. US demand for Latin American exports drop, and access to international capital markets, which several countries depend on to finance their deficits, tightens sharply or closes. For Ecuador, the exposure is acute. The country is dollarized. It cannot devalue to cushion the shock. It depends on remittances from immigrants in the US and Europe, which shrink in a recession. And it remains under an IMF program with strict fiscal targets that limit any possible countercyclical response. Ecuador has made progress. Its reserves are up, its deficit is down, but that progress is fragile and a major external shock could test it severely. So, is a crash coming? Nobody can tell you when. But the conditions are there. Historically extreme valuations, AI spending without proportional returns, a geopolitical energy shock being discounted by the market, a wave of unprofitable mega IPOs about to test institutional appetite, and a culture of silence among the people best positioned to sound the alarm. Bubbles don't deflate gradually, they burst. For developing countries, the lesson is always the same. Prosperity borrowed from Wall Street can disappear as fast as it arrived. Building resilience, fiscal buffers, economic diversification, counter-cyclical policy, this is not ideology. In the world of 2026, it is survival. I'm Luis Fierro. This is Oikos. Thank you for listening.